Good afternoon, everyone. Welcome to the webinar on our 10 years of project review experience. I'm just going to give another minute or so just for some other people to join as well. So I promise we'll start as close to the time as possible, being in the project management space, which I think is important. Okay, let's start. Like I mentioned, welcome to the webinar where we're going to share some of our 10 years of experience in project management reviews and specifically independent project management reviews. To start off with, maybe just something about myself. My name is Hannes van der Berg. I spent 17 years in a defense environment, of which all of it was in the Air Force. And the highlight during that period was me being the project officer of a Rooivalk combat support helicopter. And I was so lucky to be able to provide the operational baseline that they could utilize when I left. So after the 17 years, I joined Project Link in 2008. And that's also 17 years that I've been with Project Link. And during that period of time, I've been involved in project management in mining, process, infrastructure, IT, and agriculture type of projects mostly. But I've also been involved with project reviews for 12 years. So this webinar, it's about us sharing information, 10 years plus that we've collected data on independent project reviews. And it's been collected within major mining companies. I won't name the companies for various reasons. And then during these reviews, we've either been leading independent project reviews or we form part of an independent project review where someone else took the lead. And our focus specifically from Project Link side was looking at project management integration, capital estimating, scheduling, risk management, operational readiness. However, a lot of the other disciplines have also been included in this data. And most of the time it's reviewed by other reviewers in the engineering field or in specific fields such as environment or safety. And during these 10 years, we've reviewed 73 projects, of which 49 were stay in business projects, 20 were major capital projects, 3 were health checks. So those are projects that are already in flight, in execution. And we also reviewed 1 compliance project. So a lot of these projects was usually in the study phases. So it's either in FEL 1, 2, or 3, that being concept, pre-feasibility, or feasibility. So the majority of the reviews that we did was basically at the end of feasibility before it goes into execution. And then the specific industries, mining and minerals, infrastructure and energy. So maybe to start off with just the explanation of what independent project reviews are. So it's basically a structured review that is evidence-based, and it basically challenges the project's readiness and the risks and the value that it's going to provide. So it's while it's usually still in pre-approval phase when we do the independent project reviews. Who does it? It's important for independent project reviews that it's independent reviewers that stands outside of a delivery team. So you are not accountable for any of the delivery, and you don't report to the project manager. You report to the project sponsor or to the steerco or to the exco, and sometimes even to a board. When do we do it? Like I mentioned previously, during the FAL stages. So typically in most organizations, it would be when there's a gate review before you can move to the next stage. Then they would require, if it's part of their governance structure, that you have these independent project reviews. So it's at the end of concept when you go to pre-feasibility, at the end of pre-feas when you go to feasibility, and then at the end of feasibility when you go to execution. And as mentioned as well, during execution, you can have health checks as well to make sure that the project is still delivering according to the plan. And if there are any changes or if there's any progress that is not communicated correctly, one can pick that up as well. And then sometimes there's even post-mortems when the project is complete, then one can also just go and have a look to see if the value was derived or not. So the term usually is post-investment reviews. That might be familiar to you. The scope that we looked at for these reviews, it's mostly elements of a governance framework. Sometimes it's just a subset of some of the elements, and it might not be all the elements, depending on the nature of a project that we're looking at. So typically, for a process type of project, one would not necessarily look at rock engineering, or you won't look at mining, etc. So it's dependent on each type of project. So it's also important just to understand what independent project reviews are not. It's not doing any re-engineering or re-estimating. It's not a compliance audit of a people or of a project itself. It's not project management by proxy. It's not a substitute for any of the technical discipline reviews, the peer reviews that are required during the development of the engineering, or it's in no way there to offload delivery risk to someone else. So we go in, we have a look in a structured way, and we make sure that we challenge all the principles of a project to make sure that it can deliver on its objectives, or at least it's got a good chance to deliver on its objectives. So in these 10 years, with all this data, what did we actually see? And how did we actually derive it? So most organizations that we've been involved with has got a organizational project delivery framework. So some of these might be a project's way, or an investment development model, or an asset development model, or a major capital project management framework, or a minor project management framework. So all of them had a framework that basically indicates how a project will be delivered and what it needs to comply with. So the disciplines within these frameworks are very similar, but they have different names, or they're broken down into more disciplines. For instance, some would only have 14 disciplines, some other ones might have 25 disciplines, or even more than that or less than that. So out of these different organizations that we worked with, there were 6 unique finding registers. So we had to somehow match all the different disciplines and the findings so that we can compare apples to apples, and we can also basically see different themes and trends. So from the 6 unique findings registers, we had 1,266 findings across all these various elements, and we derived 20 disciplines that we felt we could actually go and map all these different disciplines coming out of a different organizational project delivery frameworks into 20 specific disciplines. So we did that, and the disciplines that we decided on, I'll just quickly run through this, but you can also read it. I'm not going to read all of it. It's business case, capital estimate, construction management, engineering governance, mining, ops readiness, procurement, risk management, schedule, scope, security. So all of those other disciplines can feed into these 20. Then what we also did was to only focus on the high significant and medium findings. So usually you would also have low findings, or you might have notes, but it's not really driving risk on a project. So the high significant and medium ones are the ones that we focused on. So just to give you an idea more or less what it means, if it's a high level finding, it's a critical gap on the project. Usually it's a fatal flaw, it's a showstopper. It's got a very high impact. And then one would also not necessarily allow a project to progress through the gate if it hasn't been resolved or accepted. Sometimes the organization just decides, well, accept the fatal flaw, well, correct it later on. But I can tell you, not in any of the reviews that we were involved in, did a project progress through a gate if there was a high risk. A significant finding is if there's a major weakness, there's some real value that is at risk. And what we typically do there is we assign an owner for near-term closure. So usually before the next stage starts, there's sometimes a little bit of downtime between approval and when the project actually ramps up again in the next stage. Those findings need to be resolved before that project goes into that next stage. If it's a medium finding, it's a notable issue, it's manageable. One can track it via controls. You don't have to hold up the project to progress, but you want it to be resolved during the rest of the project as it goes through execution of that next stage. So we took all of these, the mapped findings within these 20 disciplines, filtered it on the high, significant, and medium, and we consolidated it into a single findings register. And out of this, we identified a number of common themes for each of the disciplines. So we looked at what is the frequency of each of these themes manifesting in each discipline. So the results of the top 10 disciplines with the most findings were as follows. Capital estimating coming out number 1, followed by scope and WBS, engineering, schedule, construction management, procurement, governance, operational readiness, project execution planning, and risk management. Next, I think, was safety. So you'll also see that the majority of the findings in capital estimating are medium of nature. So it's not showstoppers, but there were also some very high level findings. So this next view actually demonstrates, based on the high findings, which disciplines stood out. It was capital estimating, engineering, that took over from scope and WBS. Procurement moved up, followed by schedule, construction management, governance, ops readiness, project execution planning, and risk management. Looking at the significant findings, it was engineering, capital estimating, scope, schedule, construction, procurement, etc. And for the medium findings, more or less the same. So if we take a bit of a deep dive into each of these disciplines, and I'm just going to discuss it at a very high level. There's a link in the comments section or in the Q&A section. Somewhere there must be a link for an article that contains a lot more information and data on this specific webinar. So it's an article we wrote, and we included all the information from this webinar in there. So please use the link, go and download the article, and then you'll get all the detail behind these elements. So the most frequent on capital estimating, the most frequent theme that came out is the owner's cost factorization. So usually at the end of feasibility, there should be a very accurate capital estimate. So the scope needs to be quite firm. You need to have a bill of quantities, etc. You also need to have a methodology of how you actually determine the bill of quantities. So it's usually takeoffs, it's units, etc. And you also need pricing from the market. So it's either tendered prices or budget quotations. So what we've seen with the owner's portion of the project, it just gets factorized. It's just a percentage of the cost of the contractor or the EPCM or of a specific discipline. So sometimes the owner would say that it's not a large number, it's 2% or it's 5% of the total cost of a project. But sometimes there are scope elements that also drive the cost. So the owner is responsible for doing the whole information management infrastructure, and that can be quite a large number. So it's not very accurate. It wasn't derived from first principles. The second one is very poor capital estimate, schedule, and scope integration. So if you look at the capital estimate, you can't see if which scope element has actually been costed. You can't see where the activity lies, what the duration would be. So that is quite a big problem on a project if you can't make sure that the complete scope has been costed and scheduled. Use of excessive allowances. So this is usually an indication if you provide allowances that the scope isn't very accurate or there are a lot of question marks around the scope quality. So typically one would provide allowances when you know that there is a cost associated with something, but you couldn't have developed the engineering yet to the right level. So you also need to declare all these allowances usually. And then as time goes by, you need to replace those allowances with proper pricing data. So that's something that came out quite frequent. Also, inadequate information in the basis of estimate. So you don't really know where the costing comes from. It's just a line item within the estimate. So there's no narrative to tell you how the estimate has been developed, how the costs are what they are, etc. Then also there's no basis for contingency allocations. So sometimes it's just a rule of thumb allocation, 10%, 15%, 20%. There's no indication if it was done through a probabilistic risk assessment, a QRA, or something similar. Also, lack of benchmarking. You don't know, is this a similar type of cost for a similar type of project in a similar type of geographic area? We've seen that quite a lot on a lot of the projects. Then the validity of the pricing data. A lot of the budget quotes have expired, so it's not really relevant anymore. Then on the scope and the WBS, the scope of work is not adequately defined. So it's a very, very weak scope that was developed. And this is usually the biggest driver for over expenditure or schedules that are not met, is because if you don't know what it is that you need to go and deliver, you can't really cost it accurately, and you also can't schedule it accurately. So most of the times, if big elements are left out, it will be a fatal flaw. That's where some of these high-level findings come from. The WBS dictionary is not defined to the appropriate level for estimating and project controls. So it's at a very high level. You can't see the granularity behind it. And what happens is you can't have a proper estimate. If you can't go and estimate it to the lowest possible level to get it as accurate as possible. And then the WBS is not broken down to the project controls levels, the account levels. So once you go into execution and you have to start monitoring and tracking the progress of a project and need to manage costs and things like that, then you don't have the level of granularity to actually go and do that. So you miss some things, which leads to project failure. The owner scope permissions, we discussed it during the capital estimating as well. So what happens is when there's a EPCM involved, they would go through a whole process to ensure that the complete scope has been documented, features in the scope baseline. And then the owners, they don't go through the same process. And then a lot of their scope that they're responsible for is not in the scope of a project. So that is things like commissioning, operational readiness, etc. Not all the stakeholders are involved in a scope development. So some critical role players are excluded. Yeah, what you've seen quite often is the people from the information management, the IT guys are not included. And it's not just for computers and telephones and things like that, but important things like IM infrastructure, cables and things like that is required for networks, etc. The battery limits are not defined, so you don't know where the scope elements actually end. On the engineering side, the design engineering management plans are very generic, so it reads like a template. If you read it, you don't know what engineering needs to be done. You don't know who needs to approve what. And that this just indicates that it wasn't well thought through. It's just the generic design engineering management plan that they provide. And just from my experience, what I've seen is if there isn't a design engineering management plan, then the engineering takes a life of its own, and there's a lot of delays on the project. The late sign-off of basis of design and design criteria. So it's a moving baseline. So the scope is never frozen. So designs get done, and then the decision is made to change the basis of a design or some of the design criteria, and there's a lot of rework that needs to take place. So before any of the engineering continues, the basis of design and design criteria needs to be signed off. If there are then changes after that, then it needs to go through a change management process, integrated change management process. Incomplete design reviews. So the owners, engineers, principal engineers are not involved, or the right people are not involved in the design reviews. And this then leads to designs that do not comply to specifications and standards. And then later on, sometimes during execution even, there are changes that needs to be incorporated. And usually these are very expensive changes. Lack of value engineering, we see this quite often as well, where value engineering hasn't been done from the start of a project, the incorporation of a value improvement practices. It's only an afterthought when they see that the project is too expensive, then they would say, well, go and apply value engineering. But the whole intention of value engineering is to ensure that you have something that's fit for purpose, that is constructible, etc. Non-adherence to standards and specifications, not achieving the engineering maturity for the stage. So usually at the end of a stage, you need to have the designs and the engineering to a certain level. We've seen that they don't necessarily do this, and they would say, don't worry, we'll do it during the next phase, during the detail engineering. But then you've already committed the scopes, you've already worked out what the estimate is, and then that leads to additional costs incurred. And then sometimes too much design engineering during a stage. So in concept, they deliver engineering at the level of feasibility, which is not necessary for that the class of estimate that you would require. And because there's different options that you need to look at during pre-feasibility, it might make a lot of engineering that you did to that level of detail. It will just lead to waste. On the schedule side, inadequate basis of schedule. So you don't know what the dependencies are and the logic of a schedule. You don't necessarily understand the path of execution of the project. There's no basis for durations. So important that there must be an accurate basis of schedule. The construction activity level of detail lacking. So the project gets to the end of feasibility, they need to go into execution now, but there's no indication of how the construction will actually take place. And that's the main part of the execution phase of a project, is to actually go and execute this and construct something. So you need to have a very good idea of how that's going to be done. Over optimistic durations, lack of benchmarking, lack of site integrated schedules. So other projects within the same site that might have an impact on your specific project, it's not been integrated. And then once the project starts, then there's bottlenecks with the induction medicals. There's clashes in terms of the laydown areas and things like that. Omission of owner's schedule activities ties in with the capital estimate and the scope as well, where it's only the activities included from the EPCM and not from the owner side. And then similar to the capital estimating, there's no basis for the schedule contingency allocation. So sometimes there's no buffer allowed within the schedule, or it's not derived from a QRA. And you don't know how they actually got to the contingency. On the construction management side, lack of constructability reviews. It's one of the value improvement practices. So what we see is at the end of feasibility, the project team hasn't really looked at how constructability will be done. For instance, if they decide they want to fabricate off-site and they actually want to sling in vessels or tanks like that, there's no lifting studies done, there's no rigging studies done, so we can't actually bring it in. Access control or just access into the site. The vessels don't actually fit through the gates, things like that. So there's a whole checklist that one needs to go through. So a lot of the projects only do it after feasibility, which is too late. It might have a significant impact on the design and also on the cost and the schedule. Similar to the design engineering management plans, the construction management plans are generic. It's not detailed. It's not site specific, which is a problem if you go into a construction phase. Lack of traffic management plans. You need to have traffic management plans to see what the impact is for safety purposes and also on operations. No legal appointments. There's no name attached to a required legal appointment, or there's no mention made of any legal appointments, which causes work to stop on site. It's also an important thing to make sure that if someone carries a legal appointment, that they're actually qualified and have the necessary training to act as a legal appointment. On procurement side, the misalignment between the POP, the procurement operating plan, the CapEx and the schedule. It reads like completely different projects sometimes. There's a poor contracting strategy. So the contract strategy gets driven by the procurement guys or what is easy on the project and not necessarily what will be best for the project. Sometimes all the work just gets allocated to one contractor without really looking at their capacity or the expertise in a certain discipline. This leads to big problems on a project, or going a EPC versus a EPCM versus a hybrid or owner managed type of contract. So it's not well thought through. Poor contractor selection, choosing the cheapest contractor without really doing any due diligence on them to see if they could really do the work or if they are sustainable, and taking them through. On the governance side, here it's mostly key documents, baseline documents that are not signed off. So a lot of these cases, it would either be showstoppers or it will be significant findings that they need to correct before the next stage. Lack of study reports at the end of a stage. That's where most of my findings come from. So you've done all these different engineering studies during the study phase, but there's no report at the end of the day to indicate and consolidate all the information and the logic behind selecting a certain option, for instance. On operational readiness, some instances, no operational readiness planning is done in a project. There's, sorry, that should be, I think that's 23. I missed the 2 there, but it should be right in, hopefully, in the article. The operational readiness plan of a project is not very site specific. Once again, reads like a template. There's lack of asset maintenance management. So no one looks at the assets that you bring in with the project. It can't be maintained going forward. So there's no plan in place to actually go and manage that. There's no critical spares. The life cycle costing hasn't been looked at. The operational readiness is not adequately resourced. So you've got a plan, but there's no one to actually go and implement that plan and manage it. On the project execution planning side, the misalignment between the PEP, the CapEx, and the schedule. Lack of project stakeholder management. So not all the stakeholders have been identified. Sometimes they just identify the steering committee members and the project team members, but don't look at anyone that can possibly have an impact on the project itself. There's also inadequate resourcing of a project team. So there are some critical positions within the project team that hasn't been resourced, and there's no indication of when those team members will be resourced, and then the project kicks off, and then very critical positions are not managed. Poorly defined project objectives. If you meet the project objectives, then the project should be successful, but it's not measurable at all, or it's not relevant really to the project. Unclear responsibility matrix between the owner's team and the contractors. Who's responsible for what, who needs to sign off what. We see that quite often as well. Or you get to the end of the feasibility stage, then there should be a responsibility assignment matrix or a RACI for the implementation stage, but it's still for the study stage, so it's not relevant. Very generic project execution plans. If you read it, you don't know what the project is about. You don't know what the baselines are. You don't know what the cost is. Risk management side, incomplete risk registers. So it's registers without proper definition of a meta language of a risk. So cause, risk, and effect. It's also risks that don't have any mitigation actions, or some very relevant risks are just not being identified. The risk register, it's sometimes like a once-off type of document that gets populated and it's not being updated. Risks that are not relevant anymore still feature there, and they still get taken into account when you do QRAs and things like that. There's also poor risk classification. It's overstated or understated. So something that should actually be a low risk is identified as a high risk just due to the probability and the impact. But if you go and quantify it at the end of the day, then you see it's actually not that big. The mitigation actions that should be specific actions are not brought into a schedule. So it's something that gets managed completely separately, but it should be actually integrated into the schedule. If it is a specific action that should form part of a baseline of a schedule. Risk sessions, representation that is inadequate. So not everyone is there, but should be there to identify the risks, all the different disciplines. We've seen some risk registers that have been populated only by the project manager. It's only his own view. So looking at these top 10 findings and what stands out in terms of the themes, we had a look at what's actually happening in the world. There's people that did a lot more research than what we did. So it's a bit of an external reality check. And we looked at 3 sources. There's a lot more than that, but 3 that I think is quite relevant. The first one is by a man called Ed Mehra. So he did a lot of work with the IPA as well, the independent project analysis. So they've collected a data set of 300 plus industrial mega projects. So a mega project is usually a project which value of where the value is larger than $1 billion. So out of these 300 projects that they had a look at, 65% of them failed to meet the business objectives. So these are projects that have been planned, they've gone through execution, and they've been implemented, and now they don't meet the business objectives. Then there's also a Danish guy, and I call him Clive Burke, but that's not the right Danish pronunciation. He and Gartner also wrote a book. He's probably got the guy that's got the biggest database of projects in the world. It's 16,000 of them. And he actually said that 8.5% of these 16,000 projects, only 8.5% of them hit time and cost. And only 0.5% hit time, cost, and benefits. That's the iron law, he calls. It's projects that are over budget, over time, and under benefits. So it looks a little bit bleak. Then McKinsey also did 2 studies. They said that 83% of recent major mining and metal projects face cost schedule issues. And mega mines average 79% cost overruns and 52% schedule delays. And about 2/3 of misses trace to poor initial assessments, not execution. So it's due to the work that was done during the study phases and not necessarily poor execution because of downtime, things like that, but it's in the planning phase. And then they also did a study in 2019 where they said only 20% of 40 plus mines delivered what the feasibility study promised. So tightening the feasibility study standards and doing proper benchmarking can actually lead to a $100 billion value opportunity. So if you just do proper study phases and you also do benchmarking. So what the literature basically says for big projects, especially in the mining environment, they miss because the front end is very weak. And from our data that we've collected from the independent project reviews, the data shows the same failure modes. So just mapping these, front end quality dominates. So the feasibility study rigor, poor scope development, poor capex, poor integrated master schedule quality, unrealistic durations, all of these type of things. If you don't correct it before the project goes into execution, then you'll be in trouble. A benchmarking gap, a lack of benchmarking. If you don't have reference class estimations, so it's a library that you collect information for similar type of projects on the actual values. If you don't have something like that, then you'll always just guess a little bit. Either integration and constructability, the misalignment of a PEP CapEx schedule, very generic construction management plans, not doing any value engineering or value improvement practices. These are all things contributing to the failure. And then some lessons learned. So things that are important by doing independent project reviews is to maintain the front-end loading standards and evidence packs. So there's certain requirements that you have to deliver to. So maintain those. And you have to check that you maintain those, and you do that through good independent project reviews. Use reference loss estimation and benchmarking. Schedule discipline. Make sure that there's a proper basis of schedule so that you can actually justify and provide assurance that the schedule has integrity. Make sure that owner activities are included in there, and also make sure that you use risk-based contingency versus percentage rule of thumb. So that also ties in with what McKinsey and Mero said. The use of constructability and VIPs, using a proper contracting strategy. And operational readiness, make sure that it's incorporated from an early stage during the study and not done in the start of execution. A couple of reasons why it's essential going forward with independent project reviews. So they attack the exact variance drivers that has been shown as real drivers for project failure. Also, what independent project review does, there's an independent challenge early on during the project when you're still in study phase, where any changes that you have to make or any additional documentation that you have to get to a next level, to a more granular level, it's a lot cheaper than doing it during the execution. So catch it early, it costs you less. They enforce evidence-based stage gate governance. So what we've seen as well is on some projects, they don't go through stage gates. It's just a green light bias. 2 billion rand mining projects just continue without really looking at the evidence if everything has been complied to. They also in turn reviews into institutional learning. This is something that I think is very valuable, is by ensuring that you learn from the faults that have been identified in projects. You can use those findings and you can correct a lot of these projects before they actually fail the stage gates. So there's a lot of lessons that can be applied. And it also grows organizational maturity growth. We've seen with project teams where we've gone through these independent project reviews 2 times or 3 times or so, they learn out of that, and the product that they present at the end of the day is of a much higher quality, giving assurance that the probability of a project failing is lower. And then it also improves credibility with decision makers, funders, and shareholders. And then a couple of critical success factors for these reviews. The right timing, make sure that if you flag a finding, you can still do something about it. There's still time to act. Make sure that the review team is completely independent. Make sure that there's a structured review process, that you can consistently and predictably apply it. Make sure that the document quality is at the right level before you start with the review. All the findings needs to be actionable. So there needs to be an owner. There needs to be a specific date of when it needs to be rectified. And it's quite clear what needs to be rectified and how. Sponsor engagement. It's very important that there is executive level support for this process. If that doesn't exist, then you cannot really apply it because the findings won't be enforceable, or the project will just continue through the gates without with any real recourse. Make sure that the findings get closed. If it's findings that need to be closed during the next phase, make sure that there are closure mechanisms and accountability. And then very important, there needs to be a constructive culture. So it's not a blame game. Everyone wants the same outcome. So it needs to be transparent. It needs to be improvement focused. It needs to be a collaboration between the reviewers and the project team. So you can't provide the wrong expectations when you start. The project team goes and develops everything, and then you say, well, this doesn't comply now. My expectation has changed. That is not a very constructive culture. So that's basically what we have from the bit of research that we've done in the previous 10 years. If there are any questions, please post them in the Q&A. And then also, if you can download that article, that will provide you with a lot more detail than I can communicate it right now. So I'm not sure if there are any questions. I hope not. Alda?
Hi, Hannes. Yes, there are two questions. The first question is, what do you think is the primary reason for project teams not developing plans that cover the items you have discussed?
Well, I think it's either they don't see the value in the plans. We always say that the value is not in the plan itself after it's been completed, but actually the processes that you go through. Or there's no governance requirements for them to go and develop plans, or it's just a tick box exercise. So, they don't put any effort in, especially the guys that have done a lot of projects. They would say, well, we know exactly what we need to do. So I think the whole essence of project management is that you need to plan, do, check, and act. So it's a PDCA cycle that you go through. If you don't plan and you don't document that plan, then you're not really doing project management.
Okay, and then the second question is, do you think there are some of the documents that are just developed for the sake of the review that teams don't use to their benefit?
Yes, no, definitely. I think it ties into the first question. We see that quite often, that the project team, just before a review, they would see that they need to have a plan, like a construction management plan. Then they would say, do you have a template for a plan? And then we would provide them with a template. And then 2 days later, they'll come back and say, do you perhaps have an example of a similar type of plan that is used by another project? But that defeats the whole object. You need to actually sit down and you need to reason why you want to construct something in a certain way with certain people, looking at safety, project specific and site specific things. So definitely, I think, and it's actually quite bad and sad that people don't see the value in these plans, because it makes you think about how you're actually going to execute this. It brings a lot of things that you might not consider normally, you now consider. And I think just looking at results from Ed Merrow and IPA and Clive Burke and McKinsey, if you don't do these things and you don't understand why it's important for yourself and you don't use this, then your project is going to go the same direction as those ones. You won't you won't get the benefit at the end of the day.
Then we have another question. How much time does a review usually take?
Well, it depends on the complexity of a project and also on the number of disciplines that you have to look at. So for SIB type of projects, where the value is, I would say, below 100 million rands, it's usually 2 weeks. So 1 week to go through all the documentation, get your findings, document them, doing clarifications with the project team, because sometimes, something or a document has been omitted from the evidence pack, or something is meant in a certain way, but it's documented incorrectly. Then the second week, that's where you do the report writing, finalizing any risks or findings that you have to rewrite or that you resolve. And then for bigger projects, it can actually go up to 6 to 8 weeks, depending on the number of interactions, the complexity of integration, if there are some fatal flaws on a project that needs to be rectified, where there's still time to rectify it. So it depends on the nature and the complexity and the value of a project.
Thank you. And then the last question is, does the structure of the PMO have a bearing on success rate of the projects?
Does the structure of a PMO
have a bearing on success rate of the projects?
Well, I think it's probably the governance structure and framework that has probably got a bigger bearing on the success and the outcomes of projects. If you don't have that in place, the PMO, it just can contribute to a failure to some extent. So sometimes you have PMOs that is part of a governance framework within an organization, and they have specific roles to play. But sometimes the PMO can also help guide the projects to set them up for success right from the start, and also participate in this whole value creation process that can lead to success. So I think it's probably got a place there, but it's not as important as governance frameworks and the implementation of those governance frameworks and the support from the executives. That's my opinion.
Thank you, Hannes. That's all the questions that I see.
Thank you very much, Alda. I think if there's anything in this webinar that you think is interesting, that you might want us to provide some more information on, or maybe being a specific topic for a webinar, something like constructability or value engineering practices, those are things that can actually add a lot of value to a project. If you want something like that, please pop it in the comments here, or send us an email, and then we'll definitely come back to you with some information if you're interested. And please, once again, download that article. And thank you very much for attending. Apologies for running over time a little bit, I think, or maybe not. So thank you very much. I think that is it from my side. Thank you, everyone.